All right, everybody, Stocks by the Numbers, welcome back. Wanted to do this earnings prediction video here because we have a lot of names coming out tomorrow, and I'm going to go over just a bunch of symbols that caught my attention. These are all companies reporting earnings tomorrow, the 25th, after the market closes. So hopefully this video finds you in time, and of course, hopefully, if you do follow my personal opinion, and it works out, hopefully it works out for you. But first company I wanted to look at is Microsoft, ticker symbol msft, listed here on the NASDAQ. Stock right now closed over $409 a share, up about a point and a half, little over a third of a percent. And I jotted down some notes here, so I'm just going to go through these bullet points here with you. This company right now, market cap $3 trillion. We have a PE up here at 37. In my opinion, the PE is a little bit high. And on that $3 trillion, I mean, the company has been solid and stable. We know this. We know Microsoft is a staple in the space, really. And it looks pretty consistent. However, you can see last quarter, revenue came in above 62 billion. And before that, we were down at 56 and the low 50s. So they're actually expecting a pretty big jump here. You can see revenue estimates expected to stay above 60 at 60.86 billion on EPS of 282 a share. And in my opinion, honestly, I do think they can do it. However, when we look at the annual revenue here, you can see they brought in about 212 billion, we'll call it, for 2023. We have a 3 trillion market cap with a PE of 37. So this company is trading roughly about 15 times annual revenue. In my opinion, I would actually lean more towards puts on Microsoft, in my opinion. Switching over here to Google, again, real quick, the difference between Google with an L and Goog, G-O-O-G, is that Google has voting rights. So very similar to what we saw with Under Armour, with the two symbols UA and UAA, which is why I decided to review Google with an L, because obviously that one has voting rights. But GOOGL is Alphabet, of course, formerly known as Google. Stock closed $159.13, up 87 cents, about 0.5% here on the day. And Google, I'm actually leaning towards puts too, also, in my opinion. Now, a lot of people asked me in the past about those Magnificent Seven and all the big tech names, and I was asked many, many months ago how I felt and which ones I personally liked. And I always went on record basically saying that, in my opinion, looking at the numbers, I feel that Google and Amazon are actually the most fair valued of the larger tech names. A lot of the other companies, like we just looked at Microsoft, 15 times annual revenue, a lot of the other companies could potentially take a haircut. Google, in my opinion, is probably going to have a good quarter. We have a $2 trillion market cap, we'll call it, and we have a PE of about 27 and a quarter. And we can see the EPS has been strong. Obviously, over the years, the company has been bringing in very nice revenue here, over 307 billion in revenue for 2023. So that's about 6.5 times that current market cap of about 2 trillion, we'll call it. Revenue estimates, 78,746 billion. And you can see that basically very similar to what we just saw with Microsoft. You can see that last quarter they reported over 86.16 billion, and before that it was 76, 74, 69, and 75. So I do have a feeling that they might actually beat these numbers. However, this quarter, last quarter, they actually dipped down after earnings, and then you can see we had a little bit of a rebound back up, and then the stock continued to drop down into the 130s. So it continued to sell off. And the reason being is because they cited pressure from Microsoft and their cloud sector of Azure. So, in my opinion, I think, Microsoft may continue to grow. I just think it's a little too high. That's why I'm personally calling for puts on Microsoft. And Google, in my opinion, I think that they're still going to feel that pressure from Azure. And I think that that's going to actually, in my opinion, they may potentially pull back after earnings. And they also said previously, I went back last quarter looking at the guidance, and they said that capital expenditures will be higher in 2024 compared to 2023. So I have a feeling that Google may actually be able to meet or beat this revenue number, but I actually personally believe that the EPS may suffer here. And I know it's only $1.51 a share, but in my opinion, I have a feeling they may come in light, and I would personally, in my opinion, I would personally just lean more towards Google puts potentially just for this quarter as opposed to calls. And if these expenses are going to remain higher throughout 24 like they predicted, compared to 23, then in my opinion, they may struggle for this quarter and maybe even next quarter as well. But of course, it all depends on what the company actually reports. But in my opinion, I would go with Google puts. Next company up is Intel. Now, Intel INTC on the NASDAQ closed at 34.5 even, up 22 cents, 0.64% here on the day. We have a market cap of almost 146 billion. Our PE is now up here at almost 89. And the company has definitely made a little bit of a U-turn here. You can see the profitability side has really been chunking in nicely, and they've been beating EPS estimates now for the last 4 quarters in a row. We can see that the revenue was up here at 14 and dipped down to sub 12, but has slowly been stepping up, getting back above 14, and as of last quarter up to 15.4 billion. Now, they do have rising debt, was one of my notes that I jotted down. As you see, over the years, the debt has really consistently climbed now as of 2023, closing out at almost 50 billion. But the cash flow also, you can see the free cash flow dropped down negative here. Mine went from plus 9.66 billion down to negative 9.62 billion, and now for 2023 closing out at over minus 14.25 billion. So the company technically still has roughly 7 billion cash on hand, as you see here, but this debt, in my opinion, this rising debt, I mean, technically it was a little higher here, but also you can see that if we follow past trends, then you see that the debt made a jump from Q4 into Q1, from 22 going into 23. So if we potentially have something similar like that, then we can have maybe a mixed quarter with our debt increasing as well. And last quarter, they issued weaker Q1 guidance, which is this quarter now, and they issued guidance of 12.2 billion to 13.2 billion. Below estimates of 14.16 billion. So supposedly a lot of analysts are saying they're quote unquote still in a transition year, and estimates of 12.8 billion for this quarter. 12.8 billion, in my opinion, I mean, that's technically at the higher end of the range, right? Because again, just to give you those numbers again, original estimates for Q1 here were about 14.16 billion. The company last quarter issued this quarter's guidance of 12.2 to 13.2, right? So 12.8 is roughly 600 million higher than 12.2, but only 400 million lower than 13.2, which was the high end of the range. So they went towards the top half of the high end of the range. And I think that, in my opinion, because the company is potentially in this transition year, and the low end of the range, again, in my opinion, significantly lower than these estimates, I have a feeling that the revenue actually comes in light. But again, that's just my opinion, just a gut feeling. But in my opinion, I would actually go for puts on Intel as well. And it kind of seems like a pattern that I'm seeing here with a lot of these tech stocks. Now, we looked at Snap last time. Snap, I got that call correct. I had a feeling that these estimates were a little bit too high, and then they ended up basically citing that ad revenue was coming in weaker than they expected. So this is why, we had a big chunk. And I said, though, in my opinion, maybe about $10 a share would kind of could make the argument for maybe like a fair value or like a good discounted price for Snap, SNAP, again, here at 11.08, down 31 cents, 2.7%. But you can see that we came down to about 10.5, and the stock immediately rocketed back up to north of 12.5. So in my opinion, I feel like psychologically, I feel like a lot of traders will potentially take a position on Snap at like 10.5 lower, and then just basically anticipate that move back up to like 11.5 and potentially the 12s. But in my opinion, it almost kind of looks like a Head and Shoulders, but not really. But Snap, basically, last quarter they announced they're cutting 10% of their workforce by the end of March. So in my opinion, I have a feeling like, not necessarily to group them in with GameStop, but I know it's an example I always go back to, a situation where we could potentially be seeing lower revenue dollars actually being reported, but the company is trying to pump up the EPS side. However, Snap has been operating at a loss for quite some time, so I can appreciate the fact that they're trying to cut their workforce and trying to increase those profit margins to try to narrow that loss as well. because also this quarter, they forecasted last quarter that this quarter's EBITDA would be a loss of 55 to 95 million, above estimates of 21 million. 21 million. They're forecasting a loss of 55 to 95 million. So that's why, in my opinion, even if the company does happen to get a little boost in ad revenue here and they actually beat these estimates, I have a feeling that they're going to post a wider than expected loss based on their forecast. And the company also guided for revenue of 1.095 billion to 1.135 billion for Q1, which is this quarter. And we can see estimates of 1.12 billion. So again, almost like what we're seeing with Intel, they went slightly higher to the top half end of that range. And again, in my opinion, I have a feeling that the revenue may potentially be in line, but I think that EPS is going to come in. I think that loss is going to be wider than expected. And believe it or not, I'm actually, in my opinion, I'm looking for snap puts here, and I think we can see potentially sub $9. I mean, if they do happen to be, and I am wrong, if you're bullish on Snap, again, this is just my opinion, but if you're bullish on Snap and you want to jump in here and maybe grab some calls, this was the level that I thought we were going to see if we missed this quarter. And you can see, obviously, the stock ended up going much lower than that. But so in my opinion, if Snap is able to actually come in above these expectations, you may see a pop back up to 13 plus, in my opinion. So we know Snap could move. And this is why, again, last quarter when I did my prediction, I ended up getting it correct. But I believe Snap, dropped like 30% or something like that, 36% or something crazy. So we know that this stock can swing. So again, in my opinion, I'm personally leaning more towards puts here. But if you are bullish and you did want to roll the dice with some calls, in my opinion, I would just say maybe consider the option of protecting the downside as well, and maybe consider straddling as opposed to going all in on the call side. But again, that is just my opinion. It's not financial advice. Next company is Roku, which we looked at. And I said, in my opinion, I like Roku because I understand, again, they're also still operating at a loss. They're losing, $5 a share right now. But this market cap here, 8.9 billion. The company's beaten on EPS 3 of the last 4 quarters. And we can see that the revenue has been consistently climbing here over the quarters and over the years. So again, I understand the profitability has been taking the hit, but in my opinion, I still think there's value there. And even a lot of analysts who lowered their price targets, a lot of them still have like 80 plus, 85, 105, a lot of these price targets I'm seeing. So that's why, in my opinion, I think Wall Street agrees with me that the revenue growth is there. And believe it or not, even though the company is operating at a loss, we recently heard about Walmart stepping in to acquire Vizio. And who knows, maybe down the road, like I said, another big player in the space could potentially step in and maybe just offer Roku like $90 a share and try to take them out here while they're still operating at a loss and potentially viewed as unstable, I guess we can say, right? Because in my opinion, I was looking at Roku and I mentioned it in the Discord after they reported earnings and they chunked down, because looking at these earnings, we can see the company actually beat on both the EPS and on the revenue side, but they chunked them down. And you can see the stock was really fighting to hold these support level trend lines here that I personally drew out, and then recently started to chunk down. But we also had a little bit of a rise here, going back to the top range of this wedge here that we're in my opinion, since reporting earnings and having that drop down. So, I mean, we could, of course, make the argument that we could have some rough numbers and we can reject and drop down to the bottom end of this range, maybe about 10% drop here, maybe down to 55. Also, worst case scenario here, this is a longer term trend line going back from the bottoms of, I believe it's December 26, 2018, going about through those bottoms there of end of December 22, early January 23, and just cutting across. Again, it might not be exactly precise, but hypothetically, if this is a key support level over the longer term, as you see, you're looking at about 47.5. So if this company does really disappoint, they may really potentially chunk it down. But in my opinion, I actually don't think it's a bad buy here in the 60s, but Roku revenue estimates are lower than revenue brought in for 4 of the last 5 quarters. That was my note. And we can see revenue estimates of 843.53 million, and you can see that back here Q4 of 22 867. This was the one quarter that was less than 843, and then they posted over 847 million, over 912 million, last quarter over 984 million. So of course anything can happen, and it looks like Q1 may potentially be their weakest quarter, quote unquote, when it comes to actually revenue coming in. So this technically is a big jump because we're looking for north of 100 million year over year. But based on what they did before and even all the quarters coming after, almost hitting that billion mark, I have a feeling that 843 million, I think that the company will be able to do it. But again, because the company is operating at a loss and they widened over the last couple of years, I think this EPS loss is going to be weighted more heavily than the revenue number. And here you can see we're looking for an estimate of a loss of just below 61 cents a share. So, you know, it is a little bit of a risk here, of course, but I mean, you know, we're talking about earnings. But also zooming in, you can see that the stock shot up here Tuesday, yesterday, and you can see that today we've kind of stayed in this consolidated little flag, a little pennant kind of thing. So we could potentially make the argument that in the immediate short term, the stock is potentially bull flagging. So we could actually run up and potentially break out above this trend line here, and maybe even run up to like this fib here, 63.84, maybe even 65 if people are pumped about these earnings. However, looking at some of the headlines, it says like, you know, investors are mixed. Some people are pumped. Some people are, you know, kind of bearish about the situation. So I have a feeling everyone's just kind of sitting on their hands to wait and see. But in my opinion, I would give Roku the benefit of the doubt. And even over the longer term, I said, in my opinion, I like Roku. So in my opinion, I would probably lean towards calls. And if the stock does happen to beat, it could potentially get back above both of these support trend lines that I personally have drawn out, which could potentially get us back to above 69.5 and maybe back above 70, maybe filling this gap here that we originally came back down to of 71. I mean, it might not happen instantaneously after earnings, but I'm sure you can appreciate what I'm saying. Switching over here now, WDC, Western Digital Corporation. Stock trades on the NASDAQ, closed 69.55, down 37 cents, about 0.5% here on the day. 2023 saw a drop in revenue. We have a market cap here, 22.7 billion. We'll call it. Company is losing over $7 a share now. Beta 2 times as volatile as the market. The EPS, we can see we were incurring big losses, but the company was posting more narrow than expected losses, and they have been doing so for about the last 4 quarters in a row. And now you can see for Q3 estimates up here of positive 22 cents a share off revenue of 3.37 billion. And in my opinion, this revenue may just be a little bit too high. The assets have been going down while the liabilities have been going up. Let's pull that up for you. And we can see assets slowly trickling down from 26 billion down into the 25s. Here's in the 24s. And we can see we actually had a slight bump up here quarter over quarter for the last 2 quarters. But you can see that liabilities are actually higher than where we were when we had over 26.25 billion of assets. Now we're down almost 10% at 24.39 billion of assets, but liabilities are actually up 280 million from 14.04 billion to 14.32 billion. Assets minus liabilities yields total equity, and you can see the equity was about 12.25 billion, drops to the low 12s, mid 11s down to high 10s. And you can see that now we're at 10.07 billion. And I mentioned that lower equity means lower book value per share. And you can see the book value is almost 39 down into 38, 36, 33, 31, now sub 31 at 30.88. The debt is also almost up to about 10 billion. This company has been incurring a lot of debt. But we can see that over the years, see how they were climbing up nicely, and then boom, the revenue took a really big hit there, dropping by what looks like about 33% year over year. They turned net income negative. And again, quarterly, you can see that it looks like the revenue and the net margin percentage alike are making that U-turn recovery. So, you know, I'm not exactly bashing the company because in the long term, they could probably turn it around. But look at these numbers here, 311 down to 28, 26, 27, back up to 303. Estimates this quarter, 3.37 billion. So they're looking for like a 10% rise, more than that actually, in revenue quarter over quarter. And this time last year, for Q3, supposedly coming in now for WDC, but Q3, 2.8 billion. and now estimates are 3.37 billion. So again, in my opinion, I do kind of like the company long term because we know they're a tech stock and they, of course, could turn it around and could start really chunking up and doing well. But, you know, they recently cut their dividend here after 2020. We can see assets are still outweighing liabilities, but even quarterly, this is what I wanted to show you. You can see the debt, 736 billion up to about 8.25, almost 9 billion, 9.71 billion. That cash flow goes back negative as well, 242 million. Company holding about 2.5 billion cash on hand. So they could potentially give themselves a little bit of a wiggle room, but right now, you can see the debt is climbing, and in my opinion, I think that we're still in this potential transition mode, and I have a feeling that, me personally, I would just play WDC puts, in my opinion, if I was to take a position on Western Digital, again, WDC. T-Mobile, ticker symbol TMUS on the NASDAQ. This is a stock that almost reminds me of Tesla because if we back it up and we look at the earnings, this company has been very inconsistent on the earnings. Now, I looked at this personally, and I may have mentioned it in Discord, I don't remember, but it looked like we kind of had this rising wedge going, could have been maybe viewed as an ascending triangle, but not really. But the stock ended up chunking out above this top trend line and kind of bounced around. But now, actually, in my opinion, it almost looks like we have head and shoulder potentially. So we could maybe drop back down into this range here. It might not be the biggest drop, but in my opinion, we could potentially see where we gapped up right there, about 157. In my opinion, we could possibly come back down there into that range. And the reason why is because, again, the company, 195 billion market cap. We have a PE of about 23.5. And, you know, on paper, it might not look like it's overvalued and it should go lower, perhaps, especially if we look at the revenue that they're bringing in compared to the current market cap. But we can see that the EPS was pretty solid, but last quarter they came in with a big miss there, missing by over 12.33%, posting 167 on 191. Now EPS estimates back up to 187. This time last year they posted 158 on 152, but if their EPS, their profitability side just took a hit last quarter, who's not to say it could potentially bleed into this quarter, right? So that's why, in my opinion, having an EPS estimate, again here, 187, last quarter was 191, and they missed by a chunk. And even before that, 182, 186. So technically, they haven't reported this EPS over the last 4 quarters. But even more importantly here, if we switch over to the actual earnings coming, look at this. Look at this. The company beat earnings estimates last quarter and posted almost 20.5 billion off revenue estimates of 19.67 billion. Very nice beat, in my opinion, by over 4%. But before that, they missed every single quarter. And that's what I mean. Now we have like a flip side of a situation because now the company is potentially going to come in above revenue expectations, but they may actually flip the script and may start missing, in my opinion, on the EPS estimates. As you can see, really chunking up, 187, almost 2.25, 238. While at the same time, the revenue seemingly looks to be plateaued at between like 19.8, 19.9 billion. So in my opinion, they may have a chance to beat on the revenue side, but they may miss on the EPS side. And even looking here annually as well, you can see the company missed on annual revenue expectations 5 of the last 8 years. And on the EPS side, again, you can see opposite side, flip the script. And you can see that the company beat EPS side 6 of the last 8 years, but they missed the last 2 years in a row. So now if profitability is potentially going to be chipping away at the stock, then in my opinion, if the revenue misses, again, 7 in a row, maybe more, again, we can only see back Q1 22, but if the revenue misses didn't impact the stock, then in my opinion, it may now be these new EPS misses, which may be the catalyst to actually bring the stock down. Because you can see, again, over the years, the stock has really been on the up and up. And again, I understand it's a good business. And if you read the articles, I think they recently, you can see 163 million they invested, completed network upgrades for Arkansas, right? So they keep expanding out. They keep trying to get people on their plans and whatnot. So, you know, in my opinion, when it comes to the telecom stocks, it does seem like TMUS, T-Mobile, is probably the better performing one. But in my opinion, they also have a lot of debt as well. I wanted to show you that. We come down here, we can see the debt really shot up, went from 40 billion and change to over 100 billion, sitting here 113 billion as of the close of 2023. Now, granted, some of the other numbers have risen as well, like the free cash flow is up nicely, the cash on hand is almost 5.25 billion. So that's what I mean. The company isn't completely negative, in my opinion, but I just have a feeling that the EPS may suffer, and I may personally lean towards puts. But you can see the company started paying out that dividend there. Look at this debt though, 111 billion, almost 114, 116 and a half, down to sub 114, down to 113. But again, we can see that Q4 going into Q1 this time last year, if patterns continue, the debt actually increased going from Q4 22 into Q1 of 23. But overall, in my opinion, the revenue has also been dipping over the last couple of years. You can see this downtrend here basically throughout 23, and then they had their good Q4 quarter for 23. But you can see we were above 80 billion in 21, dipped down to 79.57 billion in 22, dipped down to 78.56 billion in 23. Now, I believe they're forecasting a little over 80 billion for 2024, but we also have short-term liabilities outweighing assets, and also the book value. The book value per share has slowly been coming down, but it does kind of bounce up and down as well. But we can see the book value now as of last quarter down to the low 54s. That's the lowest it's been going back the last several quarters. And also the equity is down as well. You can see we were holding that 70 billion mark, and you can see that we slipped into the 60s, the mid 60s, and now technically we look at that, we had a slight bump there quarter over quarter, but we're still essentially flat, and now equity is sitting down here at 64.72 billion. So, you know, in my opinion, I'm not necessarily beating up the company, but I just feel like it's a situation where, in my opinion, I mean, you missed on revenue estimates 7 of the last 8 quarters, and the stock continued to go up. So this is what I mean. In my opinion, a situation like this may just be looking for a break, and that's why I'm personally, in my opinion, I would lean more towards puts on TMUS. Again, T-Mobile. Next stock, Skechers. Skechers, in my opinion, has actually been doing pretty well. I mean, if you look at the numbers, they've been growing nicely, and the stock is up for the most part here over the years. You can see that big run up there in 2015 and just kind of stayed that and kept that value and just slowly continued to climb up. We could potentially make the argument that maybe we're in kind of like this wedge, but you know, we could maybe just kind of seesaw in this range before breaking out. As you see, this will be like June maybe, so it might take a month to actually break out. But we have estimates here on the EPS side of $1.10, revenue estimates 2.203 billion. And we have a market cap here of about 9 billion. We have a PE of only 17. And in my opinion, I would lean towards calls on Skechers, because this one also can potentially have a swing of like a nice 15. I think I've seen it swing as much as 25% on some earnings reports. So of course, you obviously want to be on the right side of the fence with this one, but we know that earnings are 100% a gamble. Please understand the risks involved. But they've been doing very well on the EPS side here. I know we had this slight hiccup last quarter, but look at the estimates jumping up here to $1.10. And the reason being is because the direct-to-consumer segment has been growing very nicely here. As you see, wholesale chunked up to 4.63 billion in 22, had a slight dip down to 4.5 billion in 23. But look at direct-to-consumer, from the low 1 billions up to 1 1/3, 1.5, had that dip in 20, and then climbed up to 1.8. 2.8 billion in 22, 3.5 billion in 23. So I think, in my opinion, by going direct to consumer, they're strengthening their EPS. And in my opinion, I would probably look at this nice growth here year over year, going from 5.46 billion up to 6.748 billion for 23. And this is why, looking at these estimates here, 2.2 billion on the revenue side could potentially be a little high. Again, this time last year, the company brought in about 2 billion even. So we're looking for 10% revenue growth year over year. And I'm not saying they can't do it, but of course there is that slight percentage chance that they may come in light on that revenue number, even though in my opinion the EPS number may be pretty solid. But honestly, I might actually give Skechers the benefit of the doubt. And this could be another situation where, in my opinion, it may be most beneficial to consider straddling. But again, personally, in my personal opinion, I would lean more towards calls on SKX as opposed to puts. But again, if you wanted to potentially straddle to protect the downside, that is entirely your own prerogative. Looking here at L3 Harris Technologies, ticker symbol LHX on the New York Stock Exchange. This is a defense company, and they've been growing very, very nicely over the years. But they also have a backlog of $33 billion. We have a market cap here of $39.5 billion right now. The company's paying a dividend yielding about 2.25%. We have a PE a touch over 32 right now. And EPS side has been extremely solid, as you see, 4 beats in a row, expecting a dip back down to 291. And that would actually just be a very, very slight increase from Q1 of 23 this time last year. But they have been steadily climbing. I know they recently got awarded an Army contract, I believe, planning to cut 5% of its workforce to save costs. So in my opinion, I think the EPS will remain stable. And you can see it getting a lot of upgrades here, upgraded to overweight, price target 238. But maintain their dividends. Yeah, see new Army contracts, expanding a production site in Orange County, Virginia. Price target 240 from 237. They sold an antenna business also for about 200 million. They got $256 million order from U.S. Army for night vision goggles. So, in my opinion, over the longer term, I do like L3 Harris. I think it's going to, I think it's a very solid company. And of course, it's one of our defense stocks. And you know how we feel here in the States about our defense stocks. But forecast last quarter, they forecasted fiscal year EPS below estimates and fiscal year revenue below estimates. Now, again, technically that was for the fiscal year, not necessarily for this quarter coming up, but you can see revenue estimates of 5.112 billion, and the revenue has really been steadily climbing here quarter over quarter, and as of last quarter bringing in 5.34 billion. But you can see that the profitability side took a little bit of a hit, and that's probably why, in my opinion, they're calling to potentially cut up to 5% of their workforce. So the revenue may actually come in because, of course, we've been dealing with a lot of turmoil overseas and whatnot. So the revenue may actually beat, and they do have a nice backlog. And I personally will go on record and say I actually like LHX, L3 Harris, in the longer term. I think it's a solid, stable company. But you can also see that it actually recently rejected off of this top resistance trend line here. It was above it for a little bit and then recently chunked down, tried to get back above, and it looks like today it actually climbed up and rejected off of it and came back down slightly. But of course, earnings are on deck, so it's all about the numbers here, in my opinion. But I have a feeling that I would personally lean more towards puts, in my opinion, on L3 Harris. Switching over now to Capital One COF. Capital One Financial COF here on the New York Stock Exchange, $148.87, up about 1 point today, about 2/3%. And Capital One EPS estimates, in my opinion, may just be too high up here at $3, almost about 3.25, on revenue of 9.348 billion. Now they do show that deposits have been increasing over the quarters, and in my opinion, the company may even be financially stable. We have a market cap here of a touch below 57 billion, a dividend yielding 1.6% in change. We have a PE of about 12 1/3, we'll call it. But we can see the EPS estimates have been slipping down, and now you can see we have a bump up here to 3.25. But we can see this time last year, estimates were 375. The company comes in with 231 and misses by over 38%. And also being that they're coming off a recent miss here of over 15% on the EPS side, I have a feeling that even if the revenue beats, I think the EPS may be a little bit too high. And also this trend line here, you can see I was drawing this trend line out, connecting the tops. It looks like middle of August, right around there, maybe August 13th of 21, connecting to that top there. Looks like around October 20th, 21, and just drawing that down. And you can see that we hit that recently at the end of January, had a slight rejection, bounced off the moving average, tried to retest, slight rejection, and then broke above it. And you can see that the stock sold off, got back below it, but then bounced off of this fib level here and has been up and up for a couple of days in a row, probably on anticipation of this earnings report, right? So everyone is kind of pumped about these these earnings reports. And Q1 of last year in 23, Q1 for 23, the company actually missed on the revenue and the EPS sides. At this quarter here, yes, you can see period ending March, the company missed EPS by over 38% and actually came in light on the revenue by 1.7%. But in my opinion, the revenue may actually come in decent, but I actually wanted to compare with another company, if you recall, that came out. We had a lot of the other big banks come out and report earnings, and they had some decent quarters actually across the board, but all banks took a hit. And you can see something like JP Morgan came down to this fib of 179.20 and then consistently rose here for several days, just like Capital One has. However, in my opinion, it should technically be topping out soon. As you see, in my opinion, that seems like a decent trend line, and that is why it probably rejected off of this fib level. As we see, what is that, 193.41, and we can see we got, no, 193.23. What is this fib? 193.36. Okay, so we technically didn't go up to the fib, but in my opinion, it looked like we were going to consistently keep making lower highs, if you will. And in my opinion, a rejection off of either this trend line or this fib level is probably incoming, because even after they chunked the stock down and beat the bank stocks up. So in my opinion, actually JP Morgan may potentially be in play for some puts, in my opinion. But again, I want to go back to Capital One, right? Because we're pumping the stock up. We're basically right near the highs here. And again, I know in my opinion, I think EPS estimates are a little high. Revenue estimates up there, 9.348 billion. And we can see that they've been climbing nicely over the quarters, right? Revenue has been increasing. But that's what I mean. That's why, in my opinion, I remembered that JP Morgan and the other banks just reported earnings. And just out of curiosity, I just did a little comparison to JP Morgan. And again, this time last year, the company missed top and bottom line. So in my opinion, I actually say puts on Capital One as well, COF. Next company up is Boyd Gaming. In my opinion, I mentioned that I actually like Boyd Gaming over the long term. I don't remember exactly where we looked at it, but, you know, I probably said I liked it. I don't know, maybe like somewhere around here potentially. And you can see the stock fell off. And what's more important, though, in my opinion, is the revenue has been consistently coming in above analyst expectations. Look at that last quarter, over 954 million off estimates of 928 million. Now we have estimates of a touch below 955 million, and we have a market cap right here of 6.1 billion. We're paying a dividend yielding just about 1%, and we have a PE of less than 10.5 right now. So again, the EPS has been slightly hit and miss here, 2 beats, 2 misses over the last 4 quarters. But in my opinion, the revenue coming in seems to be maintaining this low to mid 900 plus million mark. So with estimates here at about 955 million, in my opinion, I'd probably give them the benefit of the doubt. And it's actually a dip, technically. And the debt has been going down, but you can see Q1 of 23, the revenue almost 964 million, now estimates 955 million. So even though they're expecting the revenue to dip down a little bit, this is, again, another gaming, entertainment, casino company, and I said that in my opinion, during rough, tough economic times, there are certain sectors like the tobacco industry, the gambling industry, the alcohol industry. These are the types of sectors that could potentially either remain stable and keep a stable business, or they could even potentially see revenue growth during these rough economic times. So that's why, in my opinion, I'd probably personally lean towards calls on BYD, and the company, as you see, has really been consistently coming in above these revenue estimates for several quarters in a row, and actually even only ran into some EPS misses just as of late, but was able to turn it around last quarter with a nice beat on the EPS side. We have a low PE again of about 10, and again, in my opinion, I think it's basically kind of a defensive stock, and the market cap to the revenue comparison as well. Again, not always the main thing to look at, but with a lot of positives, in my opinion, that we mentioned, like the consistent income. You can see that the revenue has been consistently increasing year over year coming out of 2020 lockdowns. It's now higher than where it came from in 2020. and also 3.74 billion for the year, and the company has a market cap just of about 6 billion, which is why, in my opinion, when I originally looked at the stock, looking at a lot of these fundamentals, I said, in my opinion, even long term, just talking about holding shares, I think BYD could be a nice grower. But here in the moment for these earnings, I would actually lean towards calls on BYD. Again, that is Beyond Gaming. Next company up, the Boston Beer Company, ticker symbol SAM. Now, this company supposedly was receiving a little bit of a revenue bump from that whole Budweiser fiasco that we dealt with, but we can see that the stock really chunked down big from 900 down to sub 7.5, 750, excuse me, and continued to drop all the way down to sub 300, and has since been kind of just bouncing around in this tight little flat consolidated range. But we can see that the company missing on the top and bottom line, big miss there on the EPS side, and you can see that it just became very, very inconsistent after running so high for so long. And we could potentially make the argument that the company is undervalued maybe in the numbers, but in my opinion, based off recent results, this was Q1 of last year, and you can see the company missed EPS by a mile and actually came in light. Revenue estimates were down to 412.44 million. The company posts 410 million, ends up missing on that revenue estimates, and you can see the stock actually dipped down, but in my opinion had like a relief bounce, but then kind of started to consolidate back down again. And then we had the nice beat, we have a little bit of momentum, and then the company misses on the EPS side. And now as of last quarter, the company actually dipped that revenue down. It hit sub 400 million off low estimates, in my opinion, of only 413.5 million, we'll call it. So they missed those revenue estimates by almost 5%. And of course, the losses just fell off a cliff with that drop down in revenue. So we have been kind of channeling down in this little downward consolidation channel, recently bouncing off of this bottom trend line. Again, that's going from the bottoms of, I believe it's June 16th of 22, drawing that across. And again, it's not technically flat and it might not look perfect, but in my opinion, since this big drop, this is potentially lining up to be a long-term descending triangle, in my opinion. So we may potentially actually have the company beat estimates because they're low again here on the revenue side, about 412.5 million off EPS estimates of a loss of about 3 cents a share. So we could potentially have a bounce, in my opinion, maybe back up to 350, but it might even reject off of that top trend line and continue to come back down into the apex. And then perhaps next quarter, if the company reports mixed or light guidance, then we may potentially actually break this descending triangle and drop down. But it could potentially happen tomorrow after market close, in my opinion. They missed Q1 this time last year. Last quarter revenue, sub 400 million. I mentioned that. Gross profit is down. Operating income is down. Let's pull up the financials real quick. And we can see gross margins are down to 37.5%, we'll call it. That's the lowest it's been going back several quarters. And even before and after that, it was holding 40+%. Also, the operating margin as well, you can see, was in the low teens for a couple of quarters after coming out of those negative quarters. Jumped up to 13.24%, 13.27%. Last quarter, negative 6.21%, excuse me. And the gross profit and the operating margin dropping down. Where is my profit? Gross profit, we can see obviously the revenue kind of, seesawing around 600, 400, but then sub 400 million. But we can see total revenue minus cost of goods sold yields gross profit. And you can see the profit here, about $250 million and change, drops down to 160, 155, back up to 274. Now, as of last quarter, down to sub 148 million. And now gross profit minus operating expenses yields the operating income. And you can see we were negative tens of millions after being positive 60, 70 millions. And then they rebounded back up to almost that 80 million mark, which was technically higher than it was back here a couple of quarters before. But now, as of last quarter, you can see operating income dropping to a touch below negative 24.5 million. So in my opinion, this happened this time last year, Q4, and Q1, the numbers stayed negative. That's what I wanted to show you guys as well, looking at those margin percentages. So if we come back over here, we can see We can see the operating margin percentage, right, was negative 3.4% coming off of the double digits, the low double digits, drops to negative 3.4%. Next quarter does slightly increase, but stays negative 3.28%. Then we had our nice double digit rebound going back to positivity, and we drop back down to negative 6.2% as of last quarter. So if history repeats itself, we will also potentially post a negative operating margin. And you can also see, was it the operating margin? Yes, yes. My apologies, because I'm looking at these notes. You guys know I usually never jot down notes, but we're looking at 15 names, so I just had to make a list of a couple of bullet points. But again, you can see operating margin went negative and stayed negative the following quarter, and that was this time last year. That was this quarter. That was this quarter. So if we again repeat ourselves, we can potentially see negative operating margin as well. And that's why even if these numbers maybe even come close, I just think the drop in revenue back to the low 400 million range is now going to weigh a lot of pressure on the company's margin percentages overall. And I think that that drop and potentially even maintaining that negativity, I think they may potentially chunk it down 255 here to this fib level and potentially even 228. I don't know. But it does seem like a long-term descending wedge. Let me know if you guys agree with that technical analysis. In my opinion, it does look like a long-term descending triangle. Excuse me, not wedge. Long-term descending triangle. But, let me know what you guys think. But that's what it looks like to me, in my opinion. So, again, SAM, Boston Beer Company, in my opinion, I would lean towards puts on that one as well. Weyerhaeuser now. Revenue estimates are lower than Q1 of 23. We can see revenue estimates of 1.862 billion. And if we go back this time last year, you can see estimates were lower at 1.84, but the company posts 1.88 billion. And now we can see estimates are at 1.86 billion. So they are expecting a little bit of lighter business to come in Q1 of 24 when compared to Q1 of 23. But the gross profit is down and the operating income is also down here for this stock. No, wait, gross profit is down, as you see. The revenue dipped down to 1.77 billion last quarter, and you can see before that was basically holding the 1/8 and above the 2s, almost 3 here. And we have seemingly just been slowing down here in this sector. And in my opinion, again, I think it's because right now, first of all, this is the quarter coming out period ending March, right? So you're talking January, February, March, kind of the cold months, right? So you only have like half the country that's kind of able to potentially work and actually do construction. And in my opinion, I think like the post lockdown boom of that real estate market, I think a lot of people may have potentially already invested into their investment properties and probably bought the materials already to fix up whatever they wanted to fix up. So that's why I think even coming out of that 2021 boom here, you can see 10.2 billion down a little to 10.18, and for 23 down about 30% to 7.67 billion. So that's why I think, in my opinion, the projects may have already been done. That's why we saw the big dip down in revenue. However, they did turn the profitability around. As you see, we went from basically flat net margin percentage in Q4 of 22, jumping up to 8%, 11.5%, 11.8%, and even as revenue dipped down last quarter, the net margin went up to 12.33%. So this is why I say, in my opinion, these material stocks, LPX I've spoken about, Weyerhaeuser now, WY, this is another lumber company. In my opinion, over the long term, these personally, I feel like could be very nice long-term holds for you. And, the company paying a dividend as well, yielding about 2.5%. We have a market cap of a touch over 23 billion and a PE of 27. So in my opinion, I just think as the business is potentially slowing down here, it could be potentially viewed as overvalued, in my opinion, in the fundamentals. So we could chunk down a little bit. But over the long term, in my opinion, these stocks usually perform very well, especially as you've seen if we deal with hyperinflation and start printing more money, or deal with, some sort of quote unquote catastrophe like we had the lockdowns and whatnot. But you saw how the revenue really started to chunk up for this company, coming out of this lockdown. And, prices increased. And again, we're dealing with hyperinflation, but we are potentially slowing down. So that's why I'm saying the gross profit is now back down 468 million. That is the lowest it's been going back the last several quarters. Operating income down as well. You can see down here to 192 million. That is the lowest it's been going back the last several quarters. The chart is also showing a potential bear flag. We had this big drop here, a lot of these big chunking red days, and now we're kind of in this little consolidating little channel going into these earnings. And in my opinion, it looks like a bear flag on the technical side, but of course, people may weigh the numbers more heavily than a bear flag. But even if we do something like this, what is this low? Back here, March 24th, 23, low of 27.65. And see, even if we come up, and let's just say give the benefit of the doubt there, and we go to the bottom of the bodies as opposed to the bottom wicks, you can see a pullback there, maybe about 29 and a third, right? So that's why the sell-off and the break, if they miss, it's not going to be a massive, massive pullback. But in my opinion, if I was going to play it based on what I'm looking at, in my opinion, I would probably lean towards the put side. And also to show you, the company has missed on revenue estimates 4 of the last 5 quarters, including the last 3 quarters in a row. So that's why, in my opinion, I would probably personally lean towards puts on Weyerhaeuser. And the last one I wanted to look at was Juniper Networks. Now, I know Juniper recently got this $40 a share bid from HPE, Hewlett Packard Enterprises. HPE supposedly looking to accelerate their AI business. And in my opinion, supposedly a stock is worth what anyone's willing to pay for it. So we could make the argument that even if they miss, we can't really beat the stock up too much because supposedly they're worth, $40 a share, or at least around there. But if you look, I don't know if it's really a big deal, but there are potentially a lot of suits being filed, class action suits and whatnot. You can see shareholder updates here. They're investigating into the situation. Supposedly, people are speculating that they kind of just heard the offer and just kind of took it. And the speculation supposedly is that they didn't, quote unquote, look for the best possible price and the best possible offer for their shareholders. So, basically anytime anything happens, it seems like there could be potential legal action. But the company missed revenue and EPS last quarter. They did receive the buyout bid from HPE for $40 a share. We have that investigation. Revenue and EPS estimates are down now year over year. Let's see. Yeah, so you can see EPS estimates expected 41 cents a share. This time last year, they posted 48 on estimates of 43. So, and again, they just missed on the EPS side. So we could potentially see another miss on the profitability side. But, revenue to market cap overall, being the space that they're in, I can appreciate the fact that they gave them, a nice premium to the PE. And the market cap was chunked up there, I believe, 14 billion even at $40 a share. So if you look, 14 billion, it's just a touch below about 3 times revenue what they brought in last year. So, in my opinion, could be potentially viewed as a decent price. But also, if they did step in and potentially view them as a company that Hewlett Packard, quote unquote, requires, then in my opinion, I don't necessarily want to say they do have a suit, potentially a settlement on their hands here for the shareholders, but in my opinion, that may have potentially led into a bidding war. And it does lead you to believe that they could have potentially gotten even more over time, right? But then again, we don't know what the motives are. Maybe they just want to. Maybe they just want to sell the company. But yeah, I'm looking for about a 2 to 3% drop, maybe. Probably not anything crazy. And you can see there's about a point maybe down here to about 34.5 from about 35 and a third. So that's less than a point. So I think it's like 2.4, 2.5% drop or something like that. Because again, even if they come in and these numbers are light, I don't think, in my opinion, you could chunk them down to this right here and bring them back down to 30. I know we may want to if the numbers do come in, drastically light and they're forecasting for a couple of obstacles over the next 1 to 2 quarters. Totally understandable. However, again, this was a company that just got offered $40 a share, and supposedly everyone's kind of waiting for all the regulators and everybody to push this deal through. So even if they do bring this stock down to the lower 30s, which in my opinion they really shouldn't, but even if they do, then obviously once we hear news that the deal is potentially finalized, obviously the stock is probably going to go back up towards $40 a share in my opinion. So even if there is a dip, it'll be very short-lived, and like I said, potential move in my opinion maybe 2-3%, but right here in the current situation, I personally wouldn't even be playing it. But I mean, I guess technically I would say, in my opinion, they have a good chance to miss personally. So, I mean, if you want, you could potentially buy some puts here. But again, they received that $40 bid, so you're probably not going to get too much of a volatile move after earnings. But that's it. So we just reviewed 14 stocks. And all of these companies, again, are reporting earnings tomorrow, the 25th, after market close. So I just wanted to go over all that. And I went back, I put in a couple of hours. I was sitting here and I was going back. I was checking every single one of these companies' previous, 1 or 2 earnings reports, checking to see what they forecasted, comparing numbers, looking at the last couple of quarters, where they were this time last year, and, the reasons why they were potentially pumped or dumped over the last quarter or two. And I tried to just connect the dots the best I could. And unfortunately, it seems like, in my opinion, a lot of these calls are puts for the most part. But again, I did mention calls on Roku, Skechers, Beyond Gaming, BYD. All of these other symbols, in my opinion, may go lower, have a good chance to go lower, I'll say, in my opinion. But again, this is just my opinion. This is not financial advice, but I know you guys appreciate these videos, so I figured I'd stay up, put the time in today, and try to get the video out tonight so that you guys could see it throughout the day tomorrow. And, if you wanted to follow my personal opinion, then of course that's entirely your own prerogative, and any positions you do take, of course, I wish you all the very best of luck. I hope everyone makes a couple of bucks, but I'm going to end it there. So once again, Stock Spot the numbers. Thank you so much for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel, and of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they're very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. You guys sleep well. Have a good night.